Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include: are we set to have another major sports owner from mortgage banking? My interview with Professor Marvin Chang on how mortgage lenders should prioritize AI, aligning LO incentives with company incentives, driving down costs and securing a return on investment. And yes, rates are range-bound. Thanks to today's podcast sponsor, Optimal Blue. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership. Residential business is coming through in dribs and drabs for many lenders, but that doesn't stop all the random news out there. To no one's surprise, Compass is suing Zillow, the owner of Zillow Home Loans, which has seen its volumes expanding nicely as of late. The inventory crunch is definitely behind us, as evidenced by Lennar, which is the home of MBA chair Laura Escobar, seeing its average sales price drop 8.6%. The U.S. House of Representatives passed the Homebuyers Privacy Protection Act. It'll be matched up with the Senate's version to iron out any differences, and then hopefully move up the food chain. It's trendy to own a stadium's naming rights or a professional sports franchise. Think Loan Depot, FBC Mortgage, Rate, or Dan Gilbert, who owns the Cavs, Matt Ishbia, the Suns, and now Union Homes Bill Cosgrove. I'm Ron Burgundy? Yep, his name is in the mix, along with Dreamfinders Homes CEO Patrick Zalupski as being in exclusive discussions to purchase the Tampa Bay Rays baseball team. Dreamfinders had a busy 2024, reaching company records of 8,583 closings, a pre-tax profit of $438 million, and home building revenue of $4.4 billion, which is an increase of 18% compared with 2023. For more on that story, as well as the latest employment opportunities, product software and services for brokers and lenders, webinars and trainings, and an article on why LO should care about MISMO, visit ChrismanCommentary.com. Bonds, and mortgage rates, by extension, had the benefit yesterday of both a safe haven trade following the U.S. strikes on Iran over the weekend, and a trade grounded in some increased hope that the Fed could cut rates at the July Federal Open Market Committee meeting. The former was driven by the U.S. strikes on 3 Iranian nuclear facilities over the weekend, while the latter was precipitated by Fed Governor Bowman saying she could support a rate cut in July if inflation pressures remained contained. Investors are focused on any potential response from Iran and the price of oil, and thus energy prices by extension, from any interruption to traffic through the Strait of Hormuz. A ceasefire was announced yesterday that lasted a matter of hours. Given that the trade war is already expected to add inflationary pressures for U.S. consumers, layering on an energy shock would only further the stagflation risks facing the U.S. However, the response in financial markets has been remarkably muted. Bond yields were pressured higher initially as oil prices surged, but as energy prices have come back into the pre-strike range, there's been a relative sense of calm restored to markets. Even the initial down trade in equity futures has been reversed. The takeaway is that should tensions continue to escalate between Iran and the U.S., any knee-jerk response in the Treasury market will continue to be bearish for bonds. Another check in the column of uncertainty, at least until there's greater clarity on how far Iran is willing to escalate. For today's interview, I want to welcome back to the show Professor Marvin Chang to talk about how mortgage lenders should prioritize AI, aligning LO incentives with company incentives, driving down costs, and securing a return on investment. He's an executive in residence in the engineering graduate and professional programs at Duke University and is focused on financial technology innovation across a spectrum of use cases, including real estate finance, lending, capital markets, and payments.
Combining AI and operations, which companies understand that that's probably the way of the future. What I've heard, at least if I want to provide a little value here, would be don't boil the ocean. Piecemeal out exactly what part of the operations you want done with a specific task versus thinking it can just handle the whole thing. Where do you see the blend of AI on operations?
Okay, so AI and operations, right? One thing to basically think about is like if we approach this in sort of the orthodox manner, we're not going to get there, right? And what does that mean, right? If we think about orthodoxy, well, it's like, okay, where has technology been useful in the past? Okay, well, let's double down. Let's work on that. Let's bring out, like AI in the back office, or AI to basically take out one chunk of the operation. What does that mean? Why do I say that, right? I'll reference. I'll go a little academic. Recently, there's a paper by Apple that talked about how LLMs don't really think, and it's caused a lot of agita around saying, "Wait, LLMs can't think." Well, I personally take the alternative approach, interpretation. Think about us, what we do. How much of what we do is actually thinking? Most of what we do is like pattern matching. We get stuff in front of us based on our personal experiences or what we've read or what we've learned from school. We basically figure out what's the next best action. And that's essentially what LLMs do. AI does that in spades because they've got more processing power, more memory cache to be able to pull that together.
Look,
right?
I didn't bring
But
you on the podcast to tell me I'm about to have no job here in a couple of years and I'm being rendered obsolete, but so tread lightly here.
in all seriousness, this basically will force us to think about two things. One is where do humans become useful, right? It's really the thinking. It's really thinking about things, not just general thinking, but like detecting when to go against trend. If AI is so good at saying, hey, this is the next best step because of all the statistics we throw out at this, oh yeah, okay. But at a certain point, a human can say, wait a second, that something doesn't look right. And that's where AI falls, where humans become important. And that's also a reason why AI in the back room doesn't make sense. That's the thing. How can you consider the use of AI? And the other thing is about trust, right? Trust with AI. Maybe we're putting too much trust on AI. Maybe we're putting too much expectations on AI. AI is not that smart, as we've talked about. Let's put a bow on this one. Basically, the point is we need to think about AI at the edge of working with humans, working at the edge of the process, not in some back room somewhere, pushing AI towards the edge because the technology is available for that. It's unleashing them outside the back room. And it fits because what we're seeing is that we are no longer operating like some large manufacturing plant churning out homogeneous products. We are seeing more and more heterogeneity across the board, whether it's the customers, the products we have. So that's the thing about rebooting the whole idea of how we approach AI and why it makes eminent sense to pair AI very tightly with operations.
Let's think about it in a practical sense. What are the best steps companies can take now to assess ways to go about this and where they can maximize return on blank? I think you mentioned before to me this return on blank. What are we looking for return on when we do this? How can companies bet these things?
Yeah, I mean, gosh, that's a whole nother can of worms. And return on investment. How can we measure return on investment when we can't measure return? Return is a function of a lot of stuff that's outside of our control. The interest rates, market sentiment, macroeconomic factors, all that stuff. I mean, we talked about a little bit about this previously. This idea of options, like options, financial options theory, and looking at your steps, the next steps in technology spend and operation spend and investments as a series of options. What do they offer you as a company? What does that offer? And that's the key about return, sort of moving from returns on analysis to a more of a real options perspective. Because we provide every step of the way. If you make an investment in say a pilot project or this bit of technology, you may not know exactly what the return on investment is because you don't have a hold on the return, but you have a good sense on the options that you provide each step of the way. If you go and bring in a new piece of technology, piece of kit with AI, it may open up opportunity for your next step. If it's a pricing product, you may be able to bring in more differentiated products other than GSE products as a next step. As an example, AI being able to better classify the collateral, the information you're getting, that could provide you optionality in the next phase. That's the way to think about it. But going back to your point, like, yeah, where do we begin? And this is something that I see every time I talk to folks. The game is changing. Even just previously, we as an avid listener to the to Jeremy's and Sasha's media property, right? We were talking about how maybe we're not going to see a gutting of the number of IMBs, a number of players, but maybe Jeremy posited that maybe instead of that, we're going to see a lot of these players get a lot smaller. And I think he's hitting on something, because if you look at the market overall, the top players, and it's like, 4 or 5 top players are basically going to play. They're playing game of keep away. That more and more opportunities are being basically in-housed in those platforms. Meanwhile, what's happening to the rest of us, or the rest of the companies? And I'm starting to see smaller companies, really agile smaller companies, that are making some very interesting plays, rethinking their processes, re-envisioning how they incent loan officers. Just talking to one last week, Princeton Mortgage, Rich Rydell's company. They're making a lot of very interesting moves that, coming from my old head, having spent time at large shops, it's like, wait a second, you can do that? It's like, wait, don't tell me that, how can you do this if you're not a net branch model? And he was walking me through some of the ways he's reinventing how they're paying LOs to make them behave in a manner congruent with corporate objectives. And instead of this roundabout way of figuring out pricing, a lot of times putting the lender, the lender at the back foot. So those are things. And then moreover, we're seeing how, Rich, as an example, has been incorporating AI at the edge. Small stuff, not changing the LOS, not changing, changing how the docs are processed, but sort of incorporating AI, because what fundamentally we're seeing is a lowering in the hurdle of investment for artificial intelligence. But the key is not to not to succumb to the orthodoxy, not to basically say, well, this is how it's worked before, and it'll be like that. I mean, if you look at technology, every technology leap has been disruptive. There's no easy way to the next generation technology using the same technology stack. That doesn't happen. Every time there's been a lot of disruption.
I don't want to have a conversation of pure conjecture with you. I want to make it practical. So if you say a company brought you in to consult, a mortgage company brought you in to consult on, hey, we want to revamp our process and bring in AI. What is the first step you do, and how does that progress to actually saying, let's sign the contract and get it implemented?
The first step I do is really follow the money. What is the most important set of objectives? And if it is a more of a traditional distributed retail model, figuring out how can we leverage AI writ small at the edge to improve the effectiveness of those who are bringing in the business, but at the same time doing it in a way that aligns their incentives more closely with the corporate. Get away from sort of that binge and purge process of hiring batches of LOs at very expensive clips only to see them leave a few years later. That's really important, because if you think about the cost crisis that we face, a good half of that cost is on bringing in the business. And if you can streamline that and make that more efficient, make that more effective, that's the first step. Then you can align their incentives, their objectives with the corporate products, the ideas of customer for life, or at least customer for more than one product every 5 years, 7 years.
I want to follow the money in this way. How does this actually ultimately drive the cost of originating a mortgage down? I don't want to get into an LO comp discussion. Let's talk from just an efficiency of process standpoint. How does this actually get us to low origination costs.
In this idealized world where the LOs are marching somewhat in tune, of course, they're not going to be meet corporate citizens, but having them buy into how the lender operates and works, selling the right products, less fallouts, less PEs, or at least accountable PEs, so that you understand where the pricing's at, and then driving and then connecting that with the operations. I've had enough mortgages that I knew I didn't really care about the LOs. I cared about the processors in the old days, because the processors were actually the ones who brought in the quality day in, day out. So if you compare an LO to efficiently go through what they need to do to get the business, and then you can hand it off with the right set of information, with right expectations, and also with an ecosystem of providers around that. That makes the processing easier, because if you don't cure for that, you're basically running around, in an operational sense, you're running around trying to take care of things that might not have been addressed early on. That's really, I mean, obviously, so it sounds a little zen, but really, if you think about it, that's what's critical. And what separates those who get it and those who don't is really, one is an appreciation for where technology is taking us. I think that's really key.
I just want to move from Zen and woo woo. It's kind of like where the rubber meets the road, like the reality of where we are today and how companies can actually fulfill some of these benefits that AI companies how some of these originators can fulfill some of these benefits that AI companies are touting. It seems like there's still a disconnect between hype and reality.
That is very much the case. I think there's a ton of hype. The challenge for that really is, and it depends on the types of, the level of organization. If you're talking about a large organization, they've got a larger budget, they've had to plan ahead. But if you're talking about a lot of the mid-tier, smaller organizations, they don't have the luxury of creating pilots and tests and all that. That's why I'm advocating for a much more pragmatic approach to figuring out whether AI makes sense. Most originators that we talk to, they don't have the luxury of coming up with a skunk works to figure out something. It's it either makes sense very quickly or it doesn't.
Well, before I let you go, anything else you think is important for people to hear? I love asking that question because it just shows I'm terrible at what I do. I just put the ball in your court. But anything you feel like this conversation necessitates to kind of make it complete?
I think the challenges in front of us are sort of varied.
Don't go zen on me. Do not go zen on me, Marvin.
Don't go zen. Oh man. Robbie, I love you. I especially love your shirt. It's very appropriate.
Which nobody can see here, but okay.
It's okay. It's But I think that the key for the industry is to understand that AI is not a separate thing. AI is part of what you're doing. It's hygiene for a lot of industries, and it's whether they realize or not, it's hygiene for mortgage. It's not a foo-foo, add-on chatbot thing. It's really figuring out how can you incorporate that into your workflow, whether you're an LO, a processor, or underwriter.
That's probably a good place to leave it. And we don't do foo-foo, we do woo-woo. I hear at the Chrisman Commentary Daily Mortgage News podcast. So I appreciate my main MC, Mr. Marvin Chang, coming on and talking to me. Thank you very much, sir.
Enjoy your life.
I do.
I know we do.
I do.
Vicariously, we do.
Yeah.
Federal Reserve Governor Waller on Friday and Governor Bowman yesterday broke from the cautious tone of many of their colleagues by suggesting that the Fed could begin cutting interest rates as soon as July. Citing a lack of inflationary impact from recent tariffs and growing concerns about the labor market risks, both argued that policymakers should act preemptively rather than wait for economic deterioration. They emphasized the importance of responding to actual data rather than hypothetical scenarios and encouraged the Fed to consider a rate cut at its next meeting. If upcoming inflation readings, particularly The PCE report this Friday remains soft. More dovish voices on the Fed may emerge. Meanwhile, Fed Chair Powell's Humphrey Hawkins' testimony this week in Washington, D.C. could bring political pressure for rate cuts. Yesterday was a relatively quiet day for the U.S. economic calendar. Existing home sales inched up 0.8% month over month in May, buoyed by slightly lower mortgage rates and increased inventory. However, affordability remains a major hurdle, keeping overall activity subdued. The seasonally adjusted annual rate of 4.03 million homes sold last month is still close to the lows seen during the pandemic and not far above last year's trough of 3.9 million. According to Fannie Mae's latest economic and housing outlook, sales of existing single-family homes are now expected to total 4.14 million in 2025, a slight downgrade from last month's 4.24 million forecast due to anticipated higher mortgage rates. Fannie's report also projects modest economic growth, with real GDP rising 1.4% in 2025 and 2.2% in 2026, while mortgage rates are now expected to remain elevated through the end of 2026. Philadelphia Fed non-manufacturing for June and the Q1 current account deficit led off today's calendar. Later today brings Redbook same-store sales, April house prices from FHFA and Case-Shiller, consumer confidence in June, Richmond Fed manufacturing and services, Treasury activity that will be headlined by $69 billion of two-year notes, and Fed Chair Powell heading to the Hill to testify on the semi-annual monetary policy report to Congress before the House Financial Services Committee. We begin Tuesday with agency MBS prices unchanged from Monday's close, the 2-year yielding 3.83 and the 10-year yielding 4.33 after closing yesterday at 4.32%. It would appear that the market has settled into a definable range that could prove more durable during the summer months than previously assumed. There seems limited appetite to aggressively sell 10-year yields when yields move above 4.5%, with modest dip buying above this inflection point occurring primarily for duration's sake. As for 2-year Treasury securities, anytime rates tick above 4.0%, that duration looks cheap in the context of the Fed's rate cut messaging. Let's wrap up with a joke and some housekeeping. People are complaining about this being the hottest summer in the last 150 years. I'm more of a glass half full kind of guy. I'm thinking of it as the coldest summer in the next 150 years. Thanks again to Optimal Blue for sponsoring today's podcast. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership.